Most traders lose money because they treat crypto like gambling. I spent 2 years learning to read these markets, and here's what actually works. The key is understanding that crypto moves in cycles, but most people only look at price and miss the real signals. Trading volume tells you if a trend has strength or if it's about to collapse. Watch the whales, track support and resistance, and never trade on emotion. Most crypto traders lose money because they're guessing, not analyzing. .de. I've spent 2 years learning technical analysis, and these patterns actually work. Start with candlestick charts. Green means price went up, red means it dropped, but the real edge comes from RSI. It tells you when a coin is oversold below 30 or overbought above 70. Combine that with support and resistance levels, especially round numbers like 50,000. Wait for confirmation before you enter because false breakouts will wreck you. Fundamental analysis focuses on the real value of a cryptocurrency project. It evaluates the technology behind the blockchain. It also considers the problem the project is trying to solve. Strong real-world use cases increase a coin's long-term potential. Adoption rate is a key factor in fundamental analysis. The more users a network has, the stronger its value proposition becomes. Developer activity shows how actively a project is being improved. High development activity often indicates long-term growth potential. Partnerships with major companies can boost investor confidence. Listings on major exchanges often increase liquidity and demand. Bitcoin's network security is one reason it dominates the market. Ethereum's smart contract capability expands its use cases. Altcoins often depend on Bitcoin's performance for direction. Market dominance refers to Bitcoin's share of total crypto market cap. When Bitcoin dominance rises, altcoins may underperform. When Bitcoin dominance falls, altcoins often gain strength. Macroeconomic factors influence crypto markets significantly. Inflation rates can push investors toward digital assets. Interest rate changes affect risk appetite in financial markets. High interest rates often reduce investment in risky assets like crypto. Global economic uncertainty can increase crypto demand. Government regulations can either support or restrict crypto growth. Positive regulation often increases investor trust. Strict regulation can lead to short-term market declines. Institutional investors bring large capital into crypto markets. Hedge funds and banks influence long-term price trends. ETF approvals can significantly increase market demand. News about security breaches can negatively impact prices. Hacks and scams reduce trust in certain projects. Stablecoins provide liquidity in volatile markets. USDT and USDC are widely used stablecoins. Stablecoin supply can indicate market buying power. On-chain data provides insights into blockchain activity. Active wallet addresses show user engagement levels. Transaction volume reflects network usage. High network congestion often indicates strong demand. Gas fees on Ethereum rise during high demand periods. NFT trends can influence Ethereum-based activity. Market sentiment can shift due to influential figures. Tweets from major personalities can move prices quickly. Media coverage affects public perception of crypto. Fear, uncertainty, and doubt can trigger sell-offs. Positive sentiment can lead to buying pressure. Combining fundamental and technical analysis improves accuracy. Strong projects usually survive long-term market cycles. Market psychology plays a major role in cryptocurrency price movements. Traders often react emotionally instead of logically. Fear and greed are the two strongest emotions in crypto trading. Fear can cause panic selling during market drops. Greed can lead to buying at overinflated prices. The Fear and Greed Index measures overall market sentiment. Extreme fear often signals potential buying opportunities. Extreme greed can indicate the upcoming market correction. Herd behavior is common in cryptocurrency markets. Traders often follow the crowd instead of independent analysis. This behavior can create bubbles in the market. Market bubbles eventually lead to sharp corrections. FOMO means fear of missing out on profits. FOMO often causes impulsive buying decisions. FUD stands for fear, uncertainty, and doubt. FUD can spread quickly through social media. Influences can significantly affect market sentiment. A single viral post can move prices dramatically. Community sentiment is important for meme coins. Meme coins rely heavily on hype rather than fundamentals. Dogecoin and Shiba Inu are examples of meme coins. Whale manipulation can influence short-term price action. Large sell-offs by whales often cause panic in the market. Accumulation Accumulation by whales can signal upcoming bullish trends. Retail investors often enter late during bull markets. Institutions usually enter earlier with strategic positioning. Market cycles repeat due to human psychology. Bull markets are driven by optimism and confidence. Bear markets are driven by fear and pessimism. Emotional discipline is key to successful trading. Overtrading often results from emotional decision making. Patience is an important skill in crypto investing. Many traders lose money due to lack of risk control. Setting stop loss levels helps manage emotional stress. Taking profits gradually reduces emotional pressure. Diversification reduces risk in volatile markets. Investing all funds in one asset increases exposure. Social media hype can distort real market value. Rumors often lead to short-term price spikes or drops. Experienced traders ignore noise and focus on data. Market sentiment often shifts faster than fundamentals. Psychological resistance levels affect price movement. Breaking psychological levels can trigger strong momentum. Long-term investors focus less on short-term emotions. Understanding psychology improves trading performance significantly. Most crypto traders lose money because they're trading on emotion instead of strategy. I spent 2 years learning this the hard way. Risk management isn't sexy, but it's what keeps you in the game. Never invest more than you can afford to lose. Use position sizing to control exposure and always set stop loss orders. Most pros aim for at least a 1 to 2 risk to reward ratio on every trade. But here's what nobody tells you. The best strategy means nothing without emotional control. Keep a trading journal. Backtest your strategies and accept that no strategy guarantees profit. Discipline and consistency beat luck every time.